Welcome back, everyone. This week we're going to review ATI with a Q4 update. They released their Q4 earlier this week, so let's get into this. ATI released their Q4 as of February 1st, 2024. We'll go over the 8K, the conference call, and the investor presentation. For those who don't know, this is a play on aerospace and defense. I outline that more to some extent in this article. In the description of this video, you will find a link to this article and my overall Substack page. If you click on that, then you can find all the embedded links that's in this article, and some of them you might want to actually look into. Please remember that Cup of Coffee Capital is a reader-supported publication, so go ahead and join me if you want to. To the tourists, let me quote the C-suites to explain this industry. Quote, "This market doesn't grow in a linear fashion. It rises, then stabilizes as build rates ramp." End quote. Another quote, "We're generally synced to airframe build rates over the medium to long term, but sometimes in the process of getting there, it's a little choppy. You got to think about stair steps, not necessarily a nice gentle hill." End quote. So let's get into the share buybacks. They're doing some of those. People are excited about it. The famous quote of this conference call is, "Our goal is not to become a bank, okay?" And that was by their CFO in regards to a question about share buybacks. They said, quote, "We have never anticipated that the current $150 million program will be the last program," end quote. So, they do have share buybacks already in the works that took hold starting in 2024. You'll see it here from the investor presentation, I believe. Announced new 150 million share repurchase authorization in November. They closed the year out with roughly $744 million of cash and are looking to generate a midpoint 2024 free cash flow of $285 million. That puts them by year end at $1 billion of cash. After subtracting out the already initiated share buyback plus anticipated CapEx spend, that still leaves them with ample cash. They noted that they don't have any debt maturities scheduled before 2025. They also noted they wouldn't be using any significant amount of cash for delivering in 2024. So they're not really going to be paying down any debt in 2024, which means that all that cash is going to stay there. So if you go and look at their 2022 10K, you'll see this image, which is their debt and when it's due. So the bulk of their debt isn't even due in 2025. So keep that in mind. Even if they issued another round of buybacks to the tune of $150 million, they'd still have money for their 2025 obligations and then some. So they could theoretically pay all their 2025 obligations, do the $150 million share repurchase, do the $200 million of CapEx spend, and then damn near do another $150 million share repurchase. Okay, I'll offer you my most generous take on the effect of their current buyback program. With 127.2 million basic shares outstanding, if they do a $150 million buyback worth of shares at today's price, this would have been Thursday's price, of roughly $38.46 per share, then that's 3.9 million shares they'll be able to buy back. So approximately 3.1% of the float. Of course, there's a couple of assumptions in that. Number one, the most obvious is that that's basic shares outstanding and not diluted shares outstanding. Number two, they get to buy shares at $38.46 or less. In the conference call, their estimation is at a higher price since they think they'll only be able to buy back 2.5 million shares. Quote, Average shares outstanding are assumed to be 149.4 million in Q1 and 146.9 million for the full year. The drop in shares reflects anticipated buybacks under our current $150 million program, end quote. In other words, they're not pulling an AMR and buying back 30% of their shares, at least not yet, so temper your expectations. On to titanium. Investor presentation image here, link in the description below. Strategic progress, titanium capacity expansion on track to drive second half 2024 strength. Time and time again, they noted on the conference call that 2024 is going to be a second half of the year story. In all fairness, well, maybe not in all fairness. I'm tired of hearing this second half of the year type stuff, and I hear it in offshore oil. I don't like people that postpone reward, saying, well, it's, Bia, that's how you get in a pipe dream. So it's always a red flag to me, even though it's sometimes true. For instance, why is it true with ATI? Well, they're ramping up titanium production, and that's not really going to take full effect until the second half of the year. Then at least the first quarter is impacted by some planned outages that took longer to do the maintenance on than they thought, plus unplanned outages of equipment breaking. So that's going to kind of curtail the performance of the first quarter of 2024, which is in some sense going to debit them for the second half of the year because that's production that they lost. So they need to make up for that. So then you'll see that happen in the second half of 2024. So it is a second half of 2024 strategy. But I digress. So back to titanium. Bob Wetherbee, the CEO, had this to note, quote, sufficient titanium supply to meet ramping demand remains a critical issue across the A&D, aerospace and defense, industry. You'll recall that we restarted a significant amount of titanium mill capacity in 2023. By the end of this year, 2024, we have expanded 45% over 2022 levels. Keep in mind, to date, only a portion of this additional titanium has been converted to revenue. We're targeting the second half of 2024 to achieve full run rate of that 45% expanded capacity, end quote. Oh, no, I'm sorry. When the Richland, Washington expansion is at full production in late 2025, our total titanium mill capacity will be up by 80% over our 2022 baseline. We're on track for Richland's first melt in Q4 of this year. Our philosophy is to be melt long at the start of a growth cycle. Melting tends to be a long lead time investment and defines the potential for the rest of our operations, end quote. I find it interesting that he notes this is the start of a growth cycle. Normally, their cycles are 1 to 4 years long. If we start our counting at the pandemic low, we're now at the 4-year mark. I got into this trade late, so either I've timed the top or this cycle is going to deviate from history. A word of caution for anyone who thinks this time is different. To his point though, titanium as a percentage of sales grew 54.5% year over year, as you see here. It's important to remember that the U.S. put sanctions on some Russian alloy and titanium producers. Other than plane manufacturers ramping up production, sanctions transferring where titanium is bought from is also another catalyst for these alloy producers. This has ramped up demand, is causing bottlenecks and supply chain congestion, as airplane manufacturers have complained, and is leading ATI to ramp up production. The sanctions on VSMPO and others are helping drive business for ATI. This article helps elaborate on matters. If you click my channel in the description below, you can link to this article, and then you can click on this link because this article and another upcoming article are actually pretty interesting reads, especially the second one I'm getting ready to talk about. However, the EU, this is the article, however, the EU has not since they're considered critical minerals. The EU is still importing titanium and other critical minerals from Russia. And this is actually quite an interesting article to read about good old conspiracy things and how the people making the titanium that the EU is buying also makes defense weapons for the Russian army, and how these two different companies are so closely knit together that they even have the same CEO, and the CEO has obviously links to Putin, and on it goes. And it's quite an interesting article. I hope this is inaccurate reporting, but this article, the one I'm talking about, had this to say. However, according to Airbus, another questionable argument motivates the decision not to include critical metals in the sanctions packages. So Airbus has this to say, allegedly. The discontinuation of the use of Russian titanium for silver... What the hell am I reading? Oh, yes. Okay, so Airbus has this to say. Sorry about that. That was unprofessional. Allegedly, they said the discontinuation of the use of Russian titanium for civil aviation by the West would encourage the Russian industry to focus on defense needs. So what they're essentially saying is, if we stop buying titanium from Russia, they'll use that titanium to build more weapons instead. So we're actually doing the world a favor by buying titanium from them, because we're taking away supply that would otherwise go into their weapons. I've said it before and I'll say it again. Post hoc rationalization knows no bounds. But I digress. It would appear to me that he is suggesting which customers are driving titanium demand. He says, and quote, this is the CEO, I believe. So I would just say, when you think about titanium and you think of ATI, about half of it is probably the big D related, 20%. 30% is probably the big A, and the rest is defense. Is big B Boeing? Is big A Airbus? And well, defense is defense. The issue with this is the issues with Boeing. A bet on ATI is to some extent a bet on Boeing. Let's hope Boeing gets their act together. With headlines like this, we can't get too excited. Boeing blocked from building more 737s in hit to growth plan is the title. On to nickel-based alloys. You'll note that nickel-based alloys and specialty alloys made up 49% of their sales in 2023. A relevant note to that is that they have pass-through clauses in their contracts. Quote, in recent years, we have increased risk sharing with our customers and lowered our volatility by adding pass-through mechanisms in our contracts. As those pass-throughs reduce risk, they create fluctuation in revenues and margins from period to period. End quote. Quote, as a result of the decline in metal prices in 2023, most notably nickel, Q4 and full year 2023 had lower pass-through revenues than the same periods in 2022. Those year-over-year declines in pass-through revenue created growth headwinds of 3% and 1% for Q4 and full year 2023, respectively. End quote. Nickel took a nosedive in 2023. The pass-through mechanism allowed them to make quote-unquote outsized gains in 2022, and that same mechanism caused them to quote lose money in 2023. He said, quote, I would expect our pass-through revenue in 2024 will probably be, I don't know, 175 million, 200 million lower than we saw in 2023, which is to say that their revenues in 2024 are going to take $175 million to $200 million hit relative to 2023 because lower nickel prices, as this chart right here suggests, have gone lower and are currently basing out. Okay, on to the next topic. Margin expansion more than revenue growth. Here are some quotes to help set the scene. Quote, excluding metal impacts, we anticipate sales will grow in the upper single-digit percentage range year over year, end quote. Quote, this puts us on a strong trajectory to achieve our 2025 and 2027 goals. We're focused on exceeding $5 billion in sales and $1 billion of EBITDA within the next 4 years. We are proven to perform, end quote. And the final quote, annual free cash flow is expected to be in the range of $245 million to $325 million. At the midpoint of guidance, that's a year-over-year increase of 73%, end quote. Let's break these quotes down. They're expecting revenue to grow at upper single digits in 2024, which means that they're not expecting sales to ramp up at all year over year. 2022 to 2023 saw sales grow by 9%, and they're expecting roughly the same from 2023 to 2024. Now, so it's positive growth, yet the rate of change isn't accelerating. That's not necessarily a bad thing, just something to pay attention to, as noted in their 10Q, which is actually their 8K. Full year sales grew by 9% over 2022. So there you have it. On to the next quote. If they're targeting $5 billion in sales with a 4-year timeline, in 2023 saw $4.173 billion, so $4.173 billion, then they're either sandbagging expectations as it would only take 2 years at 9% growth to reach that goal of $5 billion of sales, or they're expecting the next 4 years to grow at a 5% average compound annual growth rate, CAGR. I also believe that they removed language from earlier conference calls of targeting $1 billion to $1.2 billion of EBITDA, I believe. So they excluded that higher range in this last conference call, which they were kind of asked about and said it's the same. Their guidance and targets and goals haven't changed. So maybe they just, for sake of brevity, were not giving the target range. But then why did they ever? But I digress on that note. They're also aspirational to get to $1 billion in EBITDA within the next 4 years. 2023 saw $634.6 million in adjusted EBITDA. I'm using adjusted EBITDA because they were referencing adjusted earnings per share implicitly in the conference call. So, for them to get to their goal of EBITDA in 4 years' time, that would require EBITDA to grow at an average of 12% annually, compound annual growth rate. Okay, so sales are on average doing a 5% CAGR over the next 4 years, yet EBITDA is going to be doing a 12% CAGR. So then, these are averages. The final quote speaks to the accelerating rate of change of free cash flow conversion. As we said, they're expecting a 73% increase in free cash flow conversion in 2024 compared to 2023. This is all to say that although the sales growth seems steady, the improvements to EBITDA, which seemingly translate well to free cash flow, are accelerating. It's the classic fixed cost business with improving margins due to cyclical tailwinds dynamic. All right, the final segment, I believe. I'm sorry about reading this horribly. I'm not in the best reading mood, let's call it today. Which is maybe why you just want to read the article instead of listen to me. Aerospace and defense. Although aerospace and defense made up 63% of their sales in Q4, it made up 59% of total 2023 sales. They stated in an earlier conference call that their goal was 65%, but that is still quite the growth from a year ago when it was at 49%. So 2022 was at 49% of their sales was aerospace and defense. Then in 2023, 59% of their sales came from aerospace and defense. And Q4 of 2023 saw 63% of their sales come from aerospace and defense, and their goal is 65%. If you look at the below chart, what you see is improvements quarter over quarter and year over year for their aerospace and defense segment, which made up 59% of 2023 sales. Their HPMC segment is 86% aerospace and defense. It's also a higher margin business. Much like USAP, this is how ATI can have portions of their business shrinking while growing portions, aerospace and defense, more than compensates and offsets that. Notice all the red in the below image? Those are business segments that shrank or grew at a slower pace year over year. The green is their aerospace and defense, the reason I'm in this name to begin with. This sort of segment shrinkage is in other categories while growing their aerospace and defense segment isn't too dissimilar from USAP, which I noted in the Q4 USAP update, link in the description below, that I've written. Or link in this article, and this article is linked in the description below, I should say. So they went from making total aerospace and defense in 2022 was $1,873,000,000, and then total aerospace and defense in 2023 was $2,474,000,000. That's we'll just call that $600 million roughly of growth. It's a 25% improvement year over year. So that's pretty good internal segmentation growth. They summed this up nicely on the conference call. Quote, "Our HPMC segment continues its sustained performance. Fourth quarter margins were 21.5%, built on our expanding A&D foundation. The fourth quarter in 2023 in total affirm the consistency and strength in this segment. Revenue and segment EBITDA increased sequentially and year over year, driven by the segment's focus on aerospace and defense in markets representing 86% of HPMC's Q4 sales. Backlog." Okay, two more small segments. Backlog, wish they kind of broke this out in more detail, but whatever. Backlog. In the conference call, they said, quote, "As we closed out 2023, backlog and customer agreements continue to build," end quote. Now, that's an interesting statement. For instance, as I noted in my Q4 USAP update, USAP had a falling backlog in each consecutive quarter in 2023. Q2 was lower than Q1, Q3 was lower than Q2, and Q4 was lower than Q3. Although it's still higher on a Q4 year-over-year time frame. So even their Q4 backlog in 2023 was more than their Q4 backlog in 2022. If you go to that article, there's an image that beautifully illustrates this. This raises attention to USAP more than it does ATI, and since ATI is the focus of this article, we won't dig any further. Okay, as a final note, fun fact, and then I'm done. I've always found it incredible how tiny differences make huge impacts. The example I always use is if a manufacturer of a product sells something for $1.10, and their all-in cost is $1, meaning they have a 10% profit margin. It costs them $1 to make it, they sell it for $1.10, they pocket the difference, which is a dime, 10 cents, that's a 10% profit margin. they get to keep a dime in profits. Now just imagine if they suffer from cost inflation to the tune of a nickel, i.e. 5%. No big deal, right? Wrong. Their profits would drop by half, by 50%. So a 5% increase in production costs results in a 50% hit to profit margins. Mind blown. The reason I bring this up is because ATI had a planned outage for doing some maintenance work plus an unplanned equipment failure. However, it took longer than expected to get those things up and running. As such, it will impact earnings per share by approximately 3 cents. 3 measly pennies. However, each cent hit that the earnings per share number takes equates to roughly $2 million of EBITDA, which is to say that a couple of mishaps cost them $6 million in Q1 numbers alone. Remember that next time your boss is rushing you to do something. Little things can make huge differences. With that, I'm done here today. Thank you for listening, and I hope you enjoyed this segment, because now we're going to do, sometimes I'll break out the weekly performance report on its own. Other times not. This week I'm not. So you can read all this if you want to. The link will be in the description below as well. I ended the week down 0.5%. As of the end of January, my year-to-date performance is negative 1.02%, while the S&P is up 2.16% as of January 31st, which is to say that I'm lagging by a 3 percentage point spread, 3.14% spread. So here's my positions. Click on the link or pause the video. So I had a share of Valaris on the dip. All these names. Saudi Arabia came out with some news about how they weren't going to expand some projects, and then the jack-up market names like Bohr, ticker symbol BORR, that thing got hit hard. Weatherford got hit hard. Pretty much everything got hit hard. And so I bought that dip, I think on a down 9%, bought that dip. But then it bounced, and then the rest of the week it kept dipping. So I'm underwater on that. And I think I'm underwater on Valaris altogether. No pun intended, but quite ironic. So yeah, now I'm down 7% on Valaris. I'm down 25% on Transocean, and Tidewater's just shrinking and shrinking, up 23%. So really what saved my ass this year is the pot stocks and the uranium stocks. I made a video a few days ago about the breaking news on uranium and Kazatomprom. Well, just go watch the video or go read the article. Anyway, so uranium ripped hard on that news. Then, my pot stocks have been kicking ass. So that's roughly 30% of my portfolio. I just realized that this screenshot does not show the percentage of my portfolio, so how great. But uranium's roughly 20% of my portfolio. Pot stocks are roughly 12% of my portfolio. And then, so that's 30%. Those things have been doing well this year. That's offset my offshore oil names, which is roughly 30% of my portfolio. And then the other 40% of my portfolio is just done shit as well. So, if it wasn't for, this is the funny thing. This is kind of what people mean when they talk about a diversified portfolio, which is here two themes, pot stocks and uranium, are offsetting other themes, offshore oil, gold. I think gold's like 12% of my portfolio, something like that. Then if you add in Sibanye-Stillwater, which is platinum. So you could say platinum group metals / precious metals. And then, that's roughly 15% of my portfolio. And then USAP and ATI's 5-ish% of my portfolio. And that's kind of break even. And then St. Joe's 15% of my portfolio. So, but pretty much 30% of my portfolio has done really well this year. 30% of my portfolio has not done well this year. And then the other 40% of my portfolio is just so-so. So that's kind of what people mean when they talk about diversity. I didn't do this necessarily, set this all up this way for diversity's sake. It's just how I set it up. But that's that. So we have the uranium news, covered that. Watch my other video. I believe my last video on that, released a few days ago. The pot stocks are doing well. Offshore names, not so much. Precious metals, not so much. And alloys are kind of floating around, not doing too much. And that's pretty much that. That's all I have to offer. So I think I'll end it there. Thank you for watching, and until next time.